Chapter 20, Master Budgets and Performance Planning. I hope everyone's doing well and everything is going well for everyone. Okay, make sure, just a gentle reminder, make sure you're keeping up your assignments. Okay, remember your grades are updated every week. If you have any questions, please come see me. The objectives here. All right, basic budgeting. What's it all about? Positive budget administration. All right, budget is, sum it up, it's a game plan. It's your goals, your strategy. And a company says, well, we want to make $1 million. That's great, but how do we get there? Why do we even have budgeting? Communication. Talk about, okay, everyone's on the same page. How are we going to get there? We coordinate all the company's goals. So, all right, here's our goal. We want to sell 1 million units. We want to make $1 million. And we evaluate performance. Okay, your budget says you should have sold 100 units. Why did you only sell 80? Or the opposite. Your budget said 100 units, you sold 200. And we focus on future. Where do we see ourselves at the end of the year? Even 2 years from now. And even motivation. A lot of times says, all right, let's get everyone involved. How are we going to reach these goals? Some of the negative effects is, obviously, affect employees consulting. Positive. Right. So the negative. Sometimes you may understate your sales to allow yourself a cushion or to receive a bonus for reaching it. Okay. Sometimes people feel a lot of pressure. They do unethical things. Creating sales, creating fake expenses, hiding expenses, or anything. Say, well, I know if I don't spend it, I'm going to lose it next period. I might just, buy a lot of unnecessary items. Give myself a bonus, so I won't lose that budget next period. Usually budgets are done for each year. Again, use rolling budgets. It says, all right, over 12 months. And a lot of times broken up by month. It says, okay, here's our yearly budget. Here's where we should be in January, February, and so on. Okay, again here, why do we even have budgets? A lot of the benefits. We see what they need to know here. These are some of the benefits. Remember not... Or, and even some of the negative outcomes too. Okay, we have master budget. Now, master budget says everything. We have our operating, investing, and financing budget. This says, okay, each area of the company, from sales to production to materials, overhead, has each individual budget, except it all rolls up into the master budget. So it's okay, roll it all up into one big master budget. Okay, so we start with the operating budget. Okay, it all starts with, again, the most important thing, sales. Remember, if you can't make sales, like a Walmart, for example, they can't make sales, nothing else matters. If no one buys things from Walmart, nothing else matters in the company. So it all starts with sales. Again, here, you have to estimate. It's okay, let's say next year, how many units do you think you're going to sell? How much do you think the selling price is going to be? Again, base it. What's the economy looking like? What's the market? What's our business capacity? What are our advertising plans? Okay, a lot of times look at, okay, usually around this time, what do we do? What did we do last year? Do we see an increase? Do we see a decrease? Do we have more competition? What's happening with it? In this example, we talk about hockey sticks. So, all right, we expect to sell a certain amount of hockey sticks. The retail, a lot of times, December's a little higher because of the holidays. Here's how much we plan to sell them for. Now again, if you sell, you got to produce. You can't just sell something you don't have. You got to make it. Okay, again, here it shows the units. You got to make the units to meet the sales. It's okay, based on our budget from sales. And if you notice, another reason why you want to do them in order, one budget a lot of times ties in the next one. So it says, okay, here's how much budget on inventory. Now it goes to the next one. It comes from the previous slide here. Your budget is sales units. How many should we produce here? It says, okay, for October, we got to make sure we produce 710 hockey sticks. November, 1,040, December 950, and so on. And these become our goals. It's okay, here's how much we got to produce every day or every month. And again, here it says, okay, here's what's going to be computed budget production units for May. And again, we're producing those materials, our products, but in the meantime, what materials do we need to make those hockey sticks? Okay, and again here, what do we need here? What materials? How many pounds? It's not all financial information. How many pounds of, let's say, wood, metal? What's the material price per pound? What's the direct total cost to make each unit? Overall, it says, okay, and here's where you keep everyone accountable for your budget. It says, listen, you're producing those hockey sticks. For the materials, you can spend $10,240 for October, $11,450 for November, and so on. That's how you hold people accountable. It says, all right, that's how much you spend. If you go under that, that's good. If you go over that, you have some explaining to do. and direct labor. So here it says here, based on what we're going to produce, how much time it takes to make each stick, here's how many labor hours we're going to have per month. And everyone gets paid $12 an hour. And you got to decide, okay, you tell your line, you tell all your employees, everyone's making $12 an hour. That's all I can pay you. You say, well, I want 15. Well, sorry, I can't pay that. My budget says I can only pay everyone $12 an hour. That's the management's job, is to make sure everyone gets paid $12 an hour and you don't go over that allotted time, 177.5 hours, and the total cost of direct labor. That's management's responsibility to make sure the employees work those allocated hours. That's all the hours that are available, and that's all that can be paid per hour. Okay, here's example 1. So it's okay here. Cost of direct materials purchased. So each material should cost $8 a pound. Total cost here, $12,960. Labor rate, in this case, is going to be $14 an hour. Total cost of direct labor. Now the last part, overhead, at least for this section, budget cost you to complete. Again here, still going to be obviously estimated based on the units, which are your overhead rate. So overall, okay, here's how much we're producing. It should be about, in this case, $2.50 an hour. How many should produce? Here's what our overhead rate should be. The fixed overhead rate, that's a given. It says, well, we know every month we got to pay for our fixed costs, rent, supervisors, and so on, $1,500. And now it says, pull from all the previous slides, all the previous, like say, budgets. Says, okay, our total cost per unit should be $17. So each hockey stick we made should be $17. Now, selling expenses. You made these products, well, you got to sell them now. So it says, all right. The sales commission, 10% of whatever your sales are, plus a salary of $2,000 to a sales manager. Now, the $2,000, that's fixed, okay? That's a sales manager. That is, they're not hourly rates. Okay, every month you make $2,000. Now, whatever your sales are from your previous budgets, okay, it's 10% of that for sales commission. And general and admin, of course, these people run the company. Again, a lot is going to be fixed. This is okay, $54,000 per year we pay them, fixed salaries, $4,500 per month. Now, each department, you have $4,500. You choose how to allocate that $4,500. That's all you're getting. And that's fixed. That doesn't change. Again, here, you see sales commissions here. Again, we're just pulling it all together. Capital expenditures means you're going to make some big purchases, such as you decide to buy a new building. You decide to sell an old building. Maybe sell some old equipment. Okay, this says, well, this year we're going to move locations. We just bought a building. Or we plan to, let's say, sell some old equipment, upgrade to some new equipment. Okay, the big one here, the cash budget. It's very important here. Remember, you can't operate without cash, and it's very important to manage it well. Okay, so we see here, let's see the cash budget. You want to follow this general formula. So we're saying, take things into account. So it's okay, we estimate, again, something like be more or less, that's fine. So all right, of all of our sales, 40% is cash, 60% is credit, and your credit terms are it should be paid the following month. So you bought something like, say, in May, if you do credit, you'll receive full payment in June. So again, a lot of times we pick up, obviously you can start with it, cash percent, 40% of our sales. And we see the 60% from any accounts receivable gets paid the following period, as we see here. Again, nothing else by that. Says, all right. Or cash budget says, all right. Remember, you bought all those materials to make those hockey sticks. Well, when do you pay? You say, well, we buy everything on account. Everything's on credit. But we always pay the following month. We bought it in May. We'll pay for it in June. So it says here, for example, you bought in October, pay in November. November, pay in December, and so on. Again here, so you see here. It says here, if inadequate, sometimes you got to have, they'll say, well, you should always have, say $10,000 cash on hand all the time. Sometimes company requirement, sometimes you might have a loan agreement that says, well, you must always have cash on hand, $10,000. If you don't, you got to get a loan. Plus, you got to take consideration, will you be paying a dividend in November? When's your dividend going to be? Maybe you won't pay a dividend. That's fine too. Except if you do decide to pay one, you got to make sure to take that into account. And you look at other things here too, from tax liabilities. When are you going to pay for it? If you got a loan, the interest payments. When did you buy the equipment? That's how cash budget looks like. Now we're putting it all together now. Everything we just did earlier. What's your beginning cash balance? What are your cash receipts? If you notice, a lot of these came from previous budgets. Is that right? What do we pay for direct materials, direct labor, salaries, commissions, dividends? If you got a bank loan, what's the interest on a bank loan? And now if you have anything left over, well, it says, well, we should always have $20,000 cash in hand at all times. Well, in this case, you decided to pay back the loan here. Again here, subtract all the payments we talked about. If you notice the income tax came due, well, we're going to pay in October. So remember, it's not going to be recurrent. Nope, it's one time we paid it, done. The dividend will be paid out in November. And then the interest payments. And of course, the payment, if your cash balance exceeds $20,000, it does to pay back the loans. And then, the good point here, it says ending cash balance in October becomes the beginning cash balance for the following month, and so on. And again, when you buy the new equipment, say, well, end of the year, $25,000. Comes out in December. And again here, always start off, of course, at the beginning of the year. Start with your sales. With your receipts. It says, okay, 40% accounts receivable. Subtract that. 70% cash for sales from prior months. It's my total receipts now. If you notice your ending receivable goes back to the next period. You collect that the next month. Your cash budget. Getting cash balance. Add your cash from sales. Cash payments. What are you paying out here? You got to pay direct materials, direct labor, other cash expenses. You give me loan activity. The loan balance can be, in this case, zero. You paid it back. And again, we did all of our budgets. Now it's time to do our financial statements. Budgeted. Cash budget's done. Now it's the income statement. Now, based on, if you notice, all this has come from our prior budgets. How much are we going to sell for the 3 months? What's our sales commission? So, okay, for the 3 months, October, November, December, here's where your net income should be. Okay, the next part, our balance sheet. Again, most of it's going to come from our prior statements. Here's where our cash should be, our receivable, equipment, accounts payable, and so on. And service companies, same thing. Again here, based on activities, again, we're following the same theory and logic here, even if it's an activity-based budgeting. Same with the merchandiser. Yeah. All right, class. Any questions? All right, class. Let me know if you have any questions. All right. Thank you.